All right, now we're going to talk about our debt to equity ratio. And this ratio I particularly prefer over the debt to assets ratio. And the reason why is because when you're talking about your debt to assets ratio, you really just want to know, you want to understand how much you're relying on debt, right? But at the same time, you need to understand how much of your own money that you're using to pay for the stuff that your company has. I would rather just put together the two characters I'm really concerned about, my debt and my equity. And that's what the debt to equity ratio does. So let's break it down step by step. Debt, the amount of money we owe, and equity, our financial claim, the money that we actually own. So if we have a Ferrari in the driveway and we've paid off 90% of it, well, we technically own 90% of it. If the Ferrari, I'm just making up numbers, I never looked up the price of a Ferrari, but let's say a Ferrari is worth $100,000 and we've worked really hard at work and we've paid off $90,000. Well, $90,000 of the value is ours. If we were to sell that vehicle for $100,000, we would keep the $90,000 and we would give $10,000 to the bank. That'd be our debt, right? So I would much rather look at the relationship between how much I owe and the amount of money that I've actually spent for the things I have, rather than separating the two things I'm really concerned with. So that's why I like the debt to equity ratio, and hopefully that allows you to sort of have more interest in it and help you remember exactly why it's important. So when you think debt to equity ratio, that's literally how you could have paid for something. All right, so a company's going to be worried about everything it has and how did you pay for everything that it has. And we're just looking at the two main ways of doing that. So let's take a look at an example really quickly. We'll say that our company, and we'll walk through this really quickly. Hopefully you guys are able to connect the dots naturally on your own. Our company owes $50,000. Okay? So you look on your balance sheet, you would see the total amount of money that our company owes. Total debt, long-term and current liabilities. Okay? Then you look at your total equity. So your preferred stock, your common stock, your retained earnings, you put all those together, the financial claim that the company actually owns, ownership of money, okay? And let's say we own $25,000. All right, so it's how much I owe over how much I actually own. Let me write that down because they sound very similar when I say it. Okay? What's the result here? This is 2 in ratio form to 1. So for every $1 we've contributed towards the things we have in the company, we've borrowed $2. I would much rather talk about this than the debt to asset ratio. Or I guess you could say equity to asset ratio. Let's just talk about the debt to equity ratio. Let's put the two main characters together and actually have an idea of what's going on instead of talking to them separately, or instead of dissecting them separately. I'd rather focus on this, okay? So very quickly, this is 2. And all right, what does that tell us? We have borrowed 2 times as much to pay for the things we have than we've actually contributed from our own, I guess in this sense, pocket. All right, from our own war chest, from how much we're able to collect issuing all those shares. And I say from our own pocket, I want you to think net income, okay? That's when we think pocket, we think net income with this series. So that's obviously a way that our company generates money. Do we feel comfortable with that? I personally don't mind it. It depends again on the company. But that's all your total debt to total equity is. Finance is just worried about how do you pay for the things you have, and can you sustain this with the right strategies? And if you have certain goals, what kind of financial decisions are you going to make, which is really how are you going to pay for things throughout that journey while you're trying to meet your goals. All right, so when we talk about long-term solvency ratios, I love total debt to total equity. All right, it's just very simply the amount of money that we owe divided by the amount of money that we own, and you're able to, just have a conversation about whatever the result is. Okay, that's it. debt to equity ratio, total debt over total equity.